This ETF Minute is sponsored by Middlefield. This video is for general informational purposes only and not personalized investment advice. This is your ETF Minute, and today we're talking about the Middlefield Healthcare Dividend ETF. The ticker is MHCD, and to do that, we've got the fund manager behind it, Rob Moffat of Middlefield. Hi, Rob.
Hi, thanks for having me back.
Thanks so much for joining us. We're going to talk about what's going on with the healthcare sector right now. But first, let's talk about the role healthcare plays in your portfolio. I think of it as a kind of a defensive part of the portfolio.
For sure. I think healthcare offers a good mix of both defense and growth. And the great part about being an active manager is that you can lean into either one of those sides depending on the prevailing market conditions. I think one of the first and foremost things to highlight right now is demographics. It's something that we've been talking about for a really long time, but the moment where demographics are actually going to have an impact on demand has finally arrived. Baby boomers are starting to turn 80 next year in 2026. And that's important because obviously seniors spend a lot more money on healthcare products and services. So we think there's some great demand tailwinds for healthcare over the next decade or so.
And I feel people have been talking, to your point, about how demographics are so favorable to the healthcare sector, but there's nuance, right? And we see that in today's market conditions where the healthcare stocks are not the star performers. And there's kind of an assault. Healthcare is such a huge basket, right? There's pharmaceuticals, there's health insurers, and there's an assault taking place in those different areas.
Yeah, that's correct. So the healthcare sector has certainly lagged this year. And up until a few weeks ago, it was at basically the biggest relative valuation discount that we've seen in 30 years. So a very steep discount that the sector has been trading at. And we're finally starting to see some green shoots emerge that these policy overhangs, and specifically tariffs, MFN drug pricing stuff coming out of the RFK Jr., they're finally starting to show that they have a lot more bark than bite. And really the fundamental backdrop hasn't really changed much at all. So we're still very constructive on the earnings power of these companies. And we do think that we're in the early stages of a sustained re-rating where sentiment is starting to improve.
Now, when you talk about a big valuation gap like that, I'm sure it's painful if you're owning some of the stocks to the downside, but does that get you excited about increasing exposure at this time?
It does. And in fact, over the last few weeks and months, we've really been getting more aggressive and buying some of these deeply discounted names that we hadn't really owned for quite a long time, but the valuations just got to a point where it seemed like you had to own them. And even if a lot of these names get back to, say, their average historical multiples, there's still 20 to 30% upside in a lot of these names, just for getting back to what we think is a reasonable level to trade at. So definitely excited, have been aggressive. We're fully invested and quite bullish right now on a lot of the names in our portfolio.
And I guess you hit on a key point that it's a really actively managed fund. You're not an index fund tracking the healthcare sector. You go in, you go out when it's appropriate.
Correct. So I think this sector, maybe more than any other sector, it's really important to be active and to be on top of things. There are times when you want to avoid certain sectors. For example, pharmaceuticals has been an area that you didn't want to have too much exposure to over the last 6 months, and we were underweight. But more recently, we've been adding back to that area. Another area that we've been adding to that we're really constructive on going forward is biotech. Biotech historically performs very well when the Fed is in a rate cutting cycle. There's a lot of patent cliffs that big pharma companies need to backfill, and there's probably going to be a wave of M&A. So, that's an area that we've been adding to in a more tactical manner.
The name in the ETF has the word dividend. So let's talk about how you layer that onto your strategies.
Yeah. So the core of the portfolio is established and mature, high quality dividend paying companies. Over 80% of the stocks in the portfolio do pay a dividend. And that lends itself to a very, stable, low volatility profile in the portfolio. And these are really high quality companies that have been around for a very long time. And as a result, they have very predictable and stable earnings, and they pay a high level of growing dividends as well. So the ETF has over a 5% distribution yield, which I think is a really attractive feature.
Rob, thank you so much for joining us. And for more information on this ETF, ticker MHCD on the TSX, you can go to middlefield.com or click the link in the show notes.